I'm talking about the kind of moment where it's late at night, the house is quiet, and you're staring at a figure on the screen that simply doesn't make sense. You withdrew $20,000 from your 401. You expected to pay taxes on $20,000. Simple, reasonable. That's how most people think retirement works. But then somehow your taxable income looks closer to $37,000. And suddenly you're asking yourself a question millions of retirees have asked. Where did that extra income come from? Here's the uncomfortable truth. The IRS isn't always looking at your retirement income the way you think it is. There are rules buried deep inside the tax code that most hardworking Americans never hear about until after they get hit by them. These aren't loopholes for the wealthy. These aren't advanced accounting tricks. These are rules that affect ordinary retirees who spent decades doing exactly what they were told to do. Save money, contribute to your 401k, claim Social Security when you retire. Enjoy the next chapter of life. The problem is that retirement isn't just about collecting checks anymore. It's about understanding how multiple systems collide with each other. And when they collide, they can cost you thousands of dollars every single year. I remember sitting with a retirement tax specialist several years ago. We were reviewing cases of retirees who thought they had done everything right. No crazy investments, no reckless spending, no risky financial moves, just regular people trying to enjoy retirement. What shocked me wasn't how much money they were spending. It was how much money they were losing without realizing it. Money disappearing through tax rules they never understood, healthcare rules they never knew existed, government formulas that quietly activated in the background. And the worst part, most of these people didn't discover the problem until the bill arrived. That's why today's conversation matters. Because if you're somewhere between 55 and 65, the decisions you make right now can determine whether retirement feels comfortable or frustrating for decades. Let's start with one of the biggest traps of all, the thing many retirees call the Social Security Tax Torpedo. Now, when most people think about Social Security, they imagine a simple transaction. You claim your benefit, the government sends you a payment. End of story. Unfortunately, that's not how the system works. The IRS uses something called combined income. And this formula catches people off guard every single year. Combined income takes your adjusted gross income, adds any tax-free interest you receive, then adds half of your Social Security benefit. That number determines how much of your Social Security becomes taxable. Read that again. Not how much you receive, how much becomes taxable. And depending on where that number lands, up to 85% of your Social Security benefit can suddenly be included in your taxable income calculation. The first time many retirees hear that, they assume they've misunderstood something. They haven't. It's real. And it surprises people because nobody talks about it during their working years. Here's where it gets even more frustrating. The thresholds that trigger this taxation were established back in 1983. Think about that for a second. Gas was under $1 a gallon. The average home price looked nothing like today's housing market. The economy was completely different. Yet the income thresholds that determine whether your Social Security becomes taxable have remained virtually frozen in time. They were never meaningfully adjusted for inflation, not once. So what happened? Inflation kept moving, wages kept moving, retirement account balances kept growing, but the thresholds stayed exactly where they were. As a result, millions of middle-class retirees now trigger rules that originally affected only a small percentage of households. And that's where people get blindsided. Let's imagine a couple. We'll call them Mark and Linda. They're 63 years old. They're retired, they receive Social Security, their bills are covered, life is reasonably comfortable. One summer, they decide to take a long-awaited vacation. Nothing extravagant, just something they've been putting off for years. They need an extra $2,000, so they withdraw it from their 401. Seems harmless, right? After all, it's their money. They earned it. They saved it. Why shouldn't they use it? What they don't realize is that their income was sitting just below one of the critical thresholds. That extra $2,000 withdrawal pushes them over the line. Now, a larger portion of their Social Security benefit becomes taxable. The result? Their taxable income increases by far more than $2,000. Instead of simply paying taxes on the withdrawal itself, they effectively trigger taxes on additional Social Security income too. That's why people call it a torpedo. The damage comes from below the surface. You don't see it coming. And by the time you notice it, the money is already gone. What makes this especially dangerous is that retirement planning software often fails to communicate the emotional reality of what happens. The spreadsheet may show a modest increase in taxes, but real people don't live inside spreadsheets. Real people see larger tax bills, smaller account balances, and retirement savings that disappear faster than expected. Over 10 or 15 years, that difference becomes enormous. I've seen retirees discover that their accounts may run out 5, 6, even 7 years earlier than their original projections suggested. Not because they spent irresponsibly, not because the market collapsed, because the withdrawal strategy didn't account for the interaction between Social Security and taxable income. That's a very different problem. And unfortunately, it doesn't stop there, because another system is waiting right behind it. Medicare. Now, when people hear the word Medicare, they often assume everyone pays roughly the same premium. That sounds logical. But it isn't true. Medicare has its own set of income-related rules, and those rules can create a second financial hit long after you've forgotten about the original decision. This is where many retirees get caught completely off guard. Imagine Mark and Linda again. A couple of years pass. They're now enrolling in Medicare. They think the vacation withdrawal from years ago is ancient history. It's over, done, forgotten. But Medicare isn't looking at this year's income. Medicare is looking backward. Specifically, it looks at income from 2 years earlier. This is called the IRMAA look-back system. And if your income crossed certain thresholds during that earlier year, you may pay significantly higher Medicare premiums. That's what surprises people. The decision feels old. The consequences feel new. It's like receiving a speeding ticket for a road you drove on 2 years ago. You barely remember the trip. For retirees, that can be incredibly frustrating, because by the time the surcharge arrives, there's usually nothing you can do to change it. The income year has already passed. The tax return has already been filed. The calculation has already been made. All that's left is the bill. And when pensions enter the picture, things become even more complicated. A pension sounds wonderful. In many ways it is. Monthly income, predictable payments, financial certainty. There's tremendous value in that. But pensions create something many retirees overlook. They create an income floor, income that arrives whether you need it or not. Unlike a brokerage account, you can't decide to skip it this year. Unlike a 401k, you can't delay the withdrawal. The money arrives, the IRS counts it, and it becomes part of every threshold calculation moving forward. Social Security, taxation formulas, IRMAA, future planning, everything. A pension isn't bad, not even close, but it changes the math. That's why retirement isn't really about individual accounts anymore. It's about how multiple income streams interact with each other. And that's the part most people never get taught. They learn about Social Security separately. They learn about Medicare separately. They learn about pensions separately. They learn about 401k separately. Nobody explains how all four systems collide. And when they do collide, that's where the expensive mistakes happen. Now, at this point, many viewers start thinking the obvious solution is Roth conversions. And for years, that was often excellent advice. Move money from your traditional retirement account into a Roth account. Pay taxes now, avoid larger taxes later. Simple, powerful, effective. But in 2026, there's a very specific issue that early retirees need to understand before blindly following that advice. And it has nothing to do with taxes. It has everything to do with health insurance, because there is a rule that can wipe out thousands of dollars faster than almost any tax strategy can save it. And most retirement content still isn't talking about it. Picture someone retiring at age 60. Maybe that's you. Maybe it's someone you know. They've worked hard for decades. The mortgage is manageable. The kids are grown. The retirement accounts look healthy. And for the first time in years, they're excited. Not nervous, excited. They finally have time to travel, time to spend with family, time to enjoy life without an alarm clock dictating every morning. But there's one challenge. They're not 65 yet, which means Medicare hasn't started. So they need health insurance. Like millions of early retirees, they go to the ACA marketplace. They compare plans, review premiums, estimate costs, and they build a retirement budget around the subsidies they're receiving. The numbers look reasonable, manageable. Then they hear something that sounds incredibly smart. Do Roth conversions now while your income is low. You've probably heard that advice, maybe from financial television, maybe from a podcast, maybe from a financial advisor, maybe from a friend. And in many situations, it's actually good advice. The problem is timing, because what works beautifully at one stage of retirement can become incredibly expensive at another. I remember talking with a friend shortly after he retired. He was 60, smart guy, careful with money, very disciplined. We were reviewing his retirement strategy over coffee, and I started saying the same thing many people would say. This might be a great time for Roth conversions. Then I started running the numbers, not just the tax numbers, the healthcare numbers. That's when it was because there was one figure that controlled almost everything: MAGI, modified adjusted gross income. Most retirees don't spend much time thinking about MAGI, but the government does. And when it comes to retirement planning, MAGI often determines whether certain benefits stay in your pocket or disappear. The ACA marketplace uses Magi to determine subsidy eligibility. And beginning in 2026, many early retirees face a challenge that didn't exist in quite the same way during the years of expanded pandemic-related assistance. The subsidy cliff becomes relevant again, and cliffs are dangerous because they don't operate gradually. A hill gives you warning, a cliff doesn't. You're fine, you're fine, you're fine, you're fine. Then suddenly you're not. Imagine a retired couple whose income sits around $65,000. Because of that income level, they qualify for substantial ACA assistance. Their annual healthcare costs remain relatively affordable. Life is good. Now, suppose they decide to convert $20,000 from a traditional 401 into a Roth IRA. Again, that sounds smart. And from a tax perspective, it might be. But that conversion counts as income. Their Magi rises. And if that increase pushes them beyond the subsidy threshold, they may lose access to thousands upon thousands of dollars in assistance. Not some of it, potentially all of it. The same healthcare policy suddenly costs dramatically more. The same doctor, the same coverage, the same insurance card, only now the subsidy is gone. That's what makes this so dangerous. The conversion itself may save a few $1,000s in future taxes, but the lost subsidy could cost far more than the tax savings. It's like finding a $100 bill while accidentally dropping a $1,000 bill out of your pocket. Technically, you gain money. Financially, you're worse off. And that's why retirement planning has to look beyond taxes. Taxes matter. Of course they do. But healthcare often becomes the bigger expense, especially between ages 55 and 64. I've met retirees who spent months researching investment strategies and almost no time studying healthcare costs. Then they discovered healthcare was one of the largest expenses in their entire retirement plan. Not market losses, not inflation, not travel, healthcare. The lesson isn't that Roth conversions are bad. The lesson is that timing matters. The right strategy in the wrong window can become the wrong strategy. That's why retirement isn't just about making smart decisions. It's about making smart decisions at the right time. And that brings us to what I believe is one of the most overlooked concepts in retirement planning: sequence. Most people focus on what to do, few people focus on when to do it. But timing changes everything. The same move can be brilliant in one phase of retirement and costly in another. Think of retirement as 3 distinct chapters. Each chapter has different rules, different opportunities, different priorities. And if you understand those phases, many of these traps become much easier to avoid. Phase 1 begins the moment you retire and continues until age 65. This phase is incredibly important. In fact, it may be the most delicate period of retirement planning. Why? Because healthcare subsidies are often still in play. Your primary objective during this phase is not maximizing Roth conversions. It's not squeezing every possible tax advantage out of the code. It's protecting your healthcare affordability. That means carefully controlling Magi. Every withdrawal matters. Every conversion matters. Every realized gain matters. Because all of them flow into the same calculation. If your income remains within the appropriate range, those healthcare subsidies continue helping you. If your income crosses the line, the cost can be immediate and painful. This is why many retirees rely more heavily on cash reserves and taxable brokerage accounts during this period. Flexibility becomes valuable, control becomes valuable, the ability to decide exactly how much income appears on your tax return becomes valuable. You aren't avoiding taxes, you're managing timing. There's a huge difference. And during this first phase, Social Security often remains untouched. That surprises some people. After all, if you've retired, why not claim immediately? Because every year you wait beyond full retirement age can significantly increase your future benefit. That increase isn't temporary, it's permanent, inflation adjusted, guaranteed by the system's formula. For many retirees, that's a powerful advantage, especially if they expect to live well into their 80s or beyond. Now let's move into phase 2. This phase generally begins at age 65 and continues until required minimum distributions start approaching. Everything changes here. The healthcare subsidy issue largely disappears because Medicare is now active. Suddenly you have more room, more flexibility, more planning opportunities. This is where Roth conversions often become significantly more attractive. Now you're no longer protecting ACA subsidies, now you're looking ahead toward future taxes. Future required minimum distributions, future Social Security interactions, future estate planning goals. This is often the genuine Roth conversion window. Not because conversions suddenly became smarter, but because one of the major constraints disappeared, the playing field changed, the rules changed, the strategy changes too. This is where many retirees can systematically move money from traditional retirement accounts into Roth accounts over several years, slowly, deliberately, methodically, without creating unnecessary tax shocks, without crossing major thresholds, without triggering consequences they didn't anticipate. That's the key. Deliberate action, not rushed action. Then comes phase 3. The years when Social Security becomes part of the income picture. For many retirees, delaying benefits creates a substantial increase in monthly income. People often underestimate how meaningful that increase can become. Imagine someone eligible for $2,500 per month at full retirement age, wait several additional years, and that benefit may rise dramatically. Not for 1 year, not for 5 years, for life. That's what makes the decision so powerful. Retirement planning isn't just about maximizing account balances, it's about creating dependable income streams that last as long as you do. And Social Security remains one of the strongest inflation-adjusted income streams available. Now, before anyone rushes out and changes their entire retirement strategy, let's pause for a moment, because every retirement situation is different. There are 3 questions that can dramatically affect everything we've discussed. Question number 1, do you have a pension? This matters more than many people realize. A pension provides stability, but it also creates taxable income you can't easily control. That income influences Social Security taxation. It influences Medicare calculations. It influences future planning decisions. Knowing your pension income is like knowing the foundation of a house. Everything else gets built on top of it. Question number 2. Are you retiring before age 65? If the answer is yes, healthcare planning becomes a major priority, possibly the major priority. The years before Medicare can be financially sensitive. Protecting healthcare affordability often deserves far more attention than people give it. Question number 3. Can you comfortably cover expenses without Social Security? If the answer is yes, delaying benefits may deserve serious consideration. If the answer is no, that's okay too. Retirement planning is not about winning a theoretical math contest. It's about living your life. There is nothing wrong with claiming benefits when you genuinely need them. Financial planning should serve your life. Your life should never be forced to serve a financial plan. And that brings me to something I hear all the time. People tell me they want to claim Social Security at 62 because they're worried about the future of the system. Honestly, I understand that concern. You've spent decades paying into Social Security. You've watched endless news reports. You've heard politicians argue. You've seen headlines predicting problems. Of course, that creates uncertainty. Of course it does. But I think many people are asking the wrong question. The question isn't only whether the system changes, the question is how long you might live. Because retirement planning is ultimately a longevity problem. What happens if you live to 85? What happens if you live to 90? What happens if you live to 95? Those are wonderful outcomes. But they require income, reliable income, sustainable income. And for many retirees, Social Security becomes increasingly valuable the longer they live. That's why claiming early isn't automatically right. And delaying isn't automatically right either. The correct answer depends on your health, your resources, your goals, your family situation, and your overall retirement plan. But whatever decision you make it based on facts, not fear. Retirement is too important for fear-based decisions. The biggest lesson from everything we've covered today is surprisingly simple. Most retirement mistakes aren't caused by bad intentions. They're caused by incomplete information. People optimize one part of the system while accidentally creating problems somewhere else. They focus on taxes but ignore healthcare. They focus on Medicare but ignore Social Security taxation. They focus on Roth conversions but ignore income thresholds. Everything is connected. That's the secret. Retirement isn't a collection of separate decisions. It's a connected system. Every withdrawal touches something. Every income source touches something. Every strategy creates consequences elsewhere. The good news is that these traps are not unavoidable. Once you understand them, you can plan around them. You can make decisions with your eyes open. You can see the road ahead instead of reacting after the fact. And that's really what good retirement planning is all about. Not predicting every future event, not finding some magical investment, not chasing perfection. It's understanding the rules well enough to avoid the biggest mistakes. Because avoiding costly mistakes often creates more wealth than finding brilliant opportunities. If you're approaching retirement, already retired, or helping someone you love navigate these decisions, take the time to understand how these systems interact. A few hours of education today can save thousands of dollars tomorrow, and sometimes that's the difference between a retirement that feels stressful and one that feels secure.